While everyone's debating whether the economy is strong or weak, they're missing the real story. The data reveals something far more exploitable. We're not experiencing one economy anymore. We're living through two completely separate economic realities, and this K-shaped split is creating systematic opportunities that most investors will completely overlook. I'm going to show you exactly how human psychology is driving this economic divide, why the patterns we're seeing now are historically predictable, and most importantly, how disciplined investors can position themselves to benefit from both sides of this split. The crowd sees confusion, we see clarity. Here's what's actually happening. Consumer spending data shows us a tale of two Americas. The top 40% of households control 85% of America's wealth and account for 60% of all spending. Meanwhile, lower-income households are pulling back dramatically. This isn't just a temporary blip, it's a systematic restructuring of economic behavior. The numbers tell the story clearly. Holiday spending expectations reveal the depth of this divide. Baby boomers are increasing their spending by 5% this year. Millennials are essentially flat. But Generation Z, they're cutting holiday spending by 34%, with nearly 40% of their remaining budget going to self-gifting rather than traditional gift-giving. This isn't just about different life stages, it's about fundamentally different economic realities. The theological lens helps us understand why this is happening. Human beings naturally sort themselves into tribes and behaviors based on their circumstances. Fear drives the lower-income groups to conserve and protect. Confidence drives the upper-income groups to spend and invest. These aren't random behaviors. They're predictable human responses to economic pressure. Now here's where the system layer becomes exploitable. The stock market has responded exactly as you'd expect to this K-shaped reality. The S&P 500 has hit 28 record highs this year, rising 14.81% year-to-date. But look deeper. The companies benefiting from upper-income spending are driving these gains, while businesses dependent on lower-income consumers are struggling. The Russell 2000 Small Cap Index actually outperformed in Q3, climbing 12% compared to the SP's 7.8%. This tells us something important. The market is beginning to recognize value in smaller companies that have been oversold due to economic fears. Meanwhile, growth stocks trade at a 12% premium to fair value, while value stocks sit at a 3% discount. Historical patterns support what we're seeing. When the S&P 500 enters Q4 in positive territory, as it has this year, the fourth quarter averages a 4.4% gain, with positive returns 83% of the time going back to 1928. Since 1990, that average jumps to 6.1% with an 88.5% success rate. The system rewards patience during these periods of economic uncertainty. But here's what most investors miss. The K-shaped economy creates opportunities on both sides. Companies serving affluent consumers benefit from continued spending power. Companies serving lower-income consumers become oversold and undervalued, creating future opportunities when conditions normalize. Charlie Munger taught us to think in terms of incentives and human psychology. Right now, the incentive structure is clear. Wealthy households have seen their net worth surge at nearly a 15% annualized rate, primarily through asset appreciation. They have both the means and the psychological confidence to spend. Lower-income households face the opposite incentives. Rising prices, stagnant wages, and increasing debt burdens create natural conservation behaviors. The Stoic approach recognizes this as neither good nor bad, it simply is. We cannot control macroeconomic trends, but we can control our response to them. Second-level thinking means looking beyond the surface narrative of economic strength or weakness to understand the underlying structural shifts. Howard Marks reminds us that superior returns come from superior insight into value. Right now, the market is pricing in continued K-shaped performance. Companies exposed to upper-income spending trade at premiums. Companies dependent on lower-income consumers trade at discounts. The question isn't which group is right, it's where the market has created mispricings. Bank of America's analysis suggests the bottom of the K will stabilize before the top collapses, supporting continued economic growth. This creates a specific opportunity structure, value in oversold lower-income plays, and momentum in upper-income beneficiaries, but with careful attention to valuation. Small-cap stocks currently trade at a 16% discount to fair value. This discount exists because the market fears broad economic weakness. But the K-shaped reality suggests this fear is misplaced. Many small-cap companies serve niche markets or have diverse customer bases that don't neatly fit the K-shaped narrative. The crowd reacts emotionally to economic data, seeing either strength or weakness. we remain disciplined, recognizing that complexity creates opportunity. The system rewards those who can hold multiple realities simultaneously, understanding that both economic strength and weakness can coexist and create different investment opportunities. Here's the key insight that ties everything together. The K-shaped economy isn't a problem to solve, it's a system to exploit. Human psychology drives predictable behaviors based on economic circumstances. These behaviors create systematic mispricings in asset values. Disciplined investors who understand both sides of the K can position themselves accordingly. The Stoic investor doesn't fight the K-shaped reality or wish for a different economic structure. We accept what is and find opportunity within it. This means building positions that benefit from continued upper income strength while identifying oversold value in areas serving lower income consumers. Your systematic response should focus on three areas. First, identify companies with genuine exposure to upper income spending power that aren't already overvalued. Second, research small cap and value opportunities that have been oversold due to broad economic fears. Third, maintain the discipline to hold positions through volatility as these structural trends play out. The market will continue to react emotionally to economic data, creating ongoing opportunities for those who understand the underlying human behaviors driving the K-shaped economy. This is exploitable because most investors cannot hold the complexity. They want simple narratives of strength or weakness, not the nuanced reality of structural economic change. Remember, superior investment returns come from superior understanding of human nature and systematic discipline in response. The K-shaped economy is just the latest manifestation of eternal human behaviors under different circumstances. Study the patterns, understand the psychology, and respond with stoic discipline. If this framework helps clarify how to think about current market opportunities, subscribe for more systematic approaches to exploiting predictable human behaviors in markets. I'll see you in the next analysis.